The stock market crash of 1929 is widely regarded as one of the most significant events in the history of the United States. On October 24, 1929, known as Black Thursday, the stock market began to plunge, leading to a sell-off that continued for several days. By the end of October, the market had lost more than 30% of its value, and the crash would go on to trigger the Great Depression, one of the most severe economic downturns in American history. The causes of the crash were complex, and historians and economists continue to debate its origins. One factor was the rapid expansion of the stock market during the 1920s, fueled by a surge of speculative buying and the widespread use of margin loans, which allowed investors to purchase stocks with borrowed money. Many investors saw the stock market as a way to get rich quick, and the widespread optimism led to a bubble-like atmosphere that was unsustainable in the long run. Another factor was the weak regulatory environment of the time, which allowed for rampant speculation and insider trading. Many companies were engaged in fraudulent practices, exaggerating their profits and manipulating stock prices in order to attract investors. The lack of transparency and oversight made it difficult for investors to make informed decisions, leading to a high level of uncertainty in the market. The impact of the stock market crash was devastating. Many investors saw their life savings wiped out, leading to widespread poverty and unemployment. Businesses were forced to close, and the entire financial system was thrown into disarray. The Federal Reserve, which was responsible for managing the money supply and regulating the banking system, was slow to respond to the crisis, exacerbating the economic downturn. The Great Depression that followed the stock market crash of 1929 was one of the most challenging periods in American history. It lasted for over a decade, and millions of people were affected by the economic hardship. The government responded with a series of programs aimed at stimulating the economy, including the New Deal, a set of policies introduced by President Franklin D. Roosevelt that aimed to create jobs and provide economic relief to those in need. Despite the severity of the stock market crash and its aftermath, the United States eventually recovered from the Great Depression, and the economy went on to experience a period of sustained growth in the decades that followed. The lessons learned from the crash led to significant reforms in the financial system, including the creation of the Securities and Exchange Commission, which was responsible for regulating the stock market and preventing fraudulent practices. In conclusion, the stock market crash of 1929 was a defining moment in American history, one that had a profound impact on the economy and society as a whole. It demonstrated the dangers of unchecked speculation and the need for responsible regulation and oversight in the financial system. While the Great Depression was a difficult period in American history, it ultimately led to significant reforms and a more stable and sustainable financial system.